What are the tax consequences of a business sale? Obviously, as a business owner, when you sell your business, you're gonna have to pay some taxes. So, sale price is one thing, but the terms have some large impact on your tax consequences. A sale price usually consists of we're selling some assets, we're selling inventory, we're selling goodwill. Sometimes it's real estate. But let's talk about the first three. Assets that you might have depreciated over time, you are subject to recaptured depreciation that is taxed as income tax. Inventory is not taxed, it's a pass-through because you usually sell it at cost. The goodwill is long-term capital gains tax. And then the last part, a non-compete. If you sign a non-compete, that's almost like an employment, right? A non-compete is I'm agreeing that I'm not going to be a competitor for certain years, is also taxed as income tax. I am not a CPA, I'm not a tax expert, so definitely as a business seller, please have that conversation with your CPA early on in the game. When you start to prepare, when you start to have the first conversations with me, when we start putting it out in the market, go talk to your CPA and say, this is what's going to happen. This is the expected sale price. We think it's going to be allocated like that. What does that mean to you? And find out from your CPA where you can save some taxes. At the end, when we have a buyer, when we negotiate an LOI, that buyer is also going to have some expectations on how to allocate the sale price. And unfortunately, what's good for the buyer is not so good for the seller. So it's an up and down. So the seller's going to want to have a lot on the assets because he can start depreciating again. They're going to want a lot on a non-compete and so forth. So it's an up and down, but as we're negotiating the LOI, it's very important that you as a seller already know what you want and what you can accept. So have that conversation with your CPA early on.